Welcome to a new technical analysis. Today is February 3rd, and we are going to conduct a deep dive into the euro to US dollar pair's behavior to identify liquidity zones and the most likely price movements. As we always repeat on this channel, trading foreign exchange and financial products carries a high level of risk and may not be suitable for all investors. The content of this video is for strictly educational purposes and does not constitute financial advice. You are solely responsible for your investment decisions and your own risk management. We begin this analysis with the commitment to learning how to interpret what the price is telling us on the charts. Looking at the daily timeframe chart, we can observe a fascinating market structure for the euro to US dollar pair. I have marked key levels representing previous session highs and lows, technically known as PDH and PDL. It is fundamental to understand that these points are not just simple lines on the chart, they are liquidity magnets. Price tends to shift from one liquidity level to another, using previous highs to seek sell orders and previous lows to capture buy orders. In this scenario, we see how the price has traced a clear path following the strong bullish impulse at the end of January. Each level you see highlighted in green and red constitutes our roadmap for the upcoming sessions. The market is constantly clearing these zones before deciding its next large-scale directional move, and our job is to identify which liquidity zone it is most likely to expand toward next. We are now dropping down to the 12-hour timeframe to gain precision in our reading. By refining the chart, we observe a critical detail, the formation of a lower high, located near the 1.1824 area. This is a clear sign of losing bullish momentum in the short term. It is fascinating to note that, just before the New York session open, the market is already leaving us clues through these local highs and lows. In this 12-hour timeframe, the structure begins to draw the intent of the large participants. Notice how the price respects these zones prior to the US volatility. These levels act as inflection points where orders accumulate. Additionally, we can already visualize interesting targets below, such as that 12-hour fair value gap that coincides with previous low levels. The transition between the London and New York sessions is when these structures are typically validated, and this lower high is our first signal that the price might be seeking liquidity at lower levels before any other major move. We are now transitioning to the 8-hour timeframe to further sharpen our operational lens. In this timeframe, an impeccable technical behavior stands out. Price is precisely respecting both the previous day's high and low. This consolidation within the previous range is a very common accumulation signal before an expansive move. Our goal in this phase of the tutorial is to determine if, by refining the timeframe as we approach the New York session, we can identify a high-probability daily entry setup. Notice how the 8-hour candles maintain the structure without forcefully breaking external liquidity levels. We are studying whether the market will use these boundaries to generate a reversal pattern or a continuation. This is the key to professional trading, not guessing, but waiting for the price to react in these zones of interest to execute our strategy with clear confirmation the moment New York volatility kicks in. We are now looking at the 4-hour timeframe, and the clock is on a decisive countdown. There are approximately 30 minutes left until the opening bell of the New York session. Take a close look at the blue arrow I have marked on the chart. It solidly reaffirms the daily high. The most important factor here is that this level has not been breached, indicating strong institutional resistance in that zone. Furthermore, after checking the economic calendar, we confirm there are no high-impact macroeconomic events scheduled for today that could generate erratic volatility or prevent a clean technical trade. Everything seems to be aligning, the structure respects the supply levels, and the fundamental context is clear. We are in the ideal scenario to look for a high-precision entry, expecting that the liquidity from the US session will act as the necessary catalyst for the move we have been projecting since the higher timeframes. As we drop down to the 1-hour timeframe, the market picture becomes much sharper. We can clearly visualize what we call a sideways formation or consolidation range. Notice how the price is trapped between two critical levels. At the top, we have a local high situated exactly at 1.1824, while at the bottom, the floor of the move is formed by the previous day's low, the PDL, located at 1.1776. This lateral movement is extremely valuable to us, as it represents a temporary balance between supply and demand. The fact that price is oscillating between these 2 points without a clear direction confirms that the market is building up energy. We are waiting for the New York session open to inject the necessary volume to break this range. The key will be to observe whether price first seeks liquidity above that 1.1824 high or if, instead, it decides to directly attack the previous day's low to continue the bearish structure we have been analyzing. We are entering the home stretch before the real volatility kicks in. Switching to the 15-minute time frame, with only 20 minutes left until the official New York Open, we observe an aggressive price displacement. The pair is directly attacking the previous day's lows, located around the 1.1776 zone. This is where trader psychology is put to the test, and the critical question arises: are we witnessing a genuine displacement with the intent to break the structure, or is it simply an institutional liquidity grab to induce selling before a bullish reversal? These types of rapid moves just before the open are often market traps designed to clear out stop-loss orders. Notice the speed of the 15-minute candles approaching the PDL. Our job at this moment is not to rush. We must wait to see how price reacts once it touches that historical support level. Will we see a strong rejection with a long wick or a solid breakout with a full candle body? The answer to this question will define our entry in the session that is about to begin. Switching to the 5-minute time frame, our view becomes much more surgical. With higher time frame liquidity zones already marked, now is the time to precisely observe how price interacts with our levels. Here, each candle reveals the real pressure between supply and demand just before the heavy New York volume hits. Notice how the structure starts giving us clues about respecting previous resistance. We aren't looking to guess, we are monitoring for signs of exhaustion or an acceleration toward the PDL. At this stage, patience is our best ally to validate if the institutional order flow follows the path we have projected. Continuing on the 5-minute time frame, we observe a key development. Price has generated a bearish displacement, leaving a fair value gap or imbalance in this area. Despite this momentum, it is fundamental to note that price is still precisely respecting the previous day's low level, the PDL. This behavior is typical of a liquidity hunt. The market creates a value vacuum while testing the strength of buyers at the main support. We are monitoring whether this FVG will act as resistance for further decline or if it is simply part of a manipulation prior to the full New York Open. The key lies in the reaction at the PDL. As long as there is no solid close below it, the reversal structure remains on the table. We are refining the chart by dropping down to the 3-minute time frame. Notice a vital detail: the price has marked today's current low, identified as low daily, just above the previous day's low or PDL. The fact that it failed to reach the PDL indicates an early entry of buyers around the 1.1779 zone. Now, the price action shows clear bullish intent, heading strongly toward the 5-minute fair value gap we left hanging above. This move seeks to balance the previous imbalance and test whether there is enough supply to resume the trend or if we are seeing the start of a deeper reversal. The 3-minute structure confirms that the lower liquidity was sufficient to drive this technical bounce. We have finally reached the 1-minute time frame, the stage for maximum precision. With only 5 minutes left until the New York Open, we observe the development of a very clear bullish microstructure. Price is building a ladder of higher lows heading directly toward the 5-minute fair value gap. This price action suggests that institutions are positioning their final orders before the heavy volume of the US session kicks in. It is vital to observe how the pair reacts upon entering the gap zone, whether price breaks through it with force or meets immediate resistance. We are at the moment of highest tension, where patience meets surgical precision to validate our entry hypothesis. The New York Open is now in full swing, and the 1-minute chart reveals a highly sensitive zone. Price has found clear resistance by simultaneously interacting with the fair value gap and an institutional order block. Notice how this area is stalling the previous bullish momentum. Meanwhile, at the bottom, the market has begun leaving breadcrumbs in the form of liquidity. I have marked 2 successive higher lows above the daily low. These levels act as magnets for internal liquidity. The structure suggests that price might be exhausting its buying power at the resistance to eventually sweep those recent lows. We are at a critical point where supply is taking control against the order block zone. We are currently within the first hour of the New York session. Since we don't see a clear entry yet in the 1-minute microstructure, we are returning to the 5-minute time frame for a more structural perspective. In this time frame, I've identified a 5-minute order block that is being respected with precision. Notice how the price is using this order block as solid support. Every time the pair tries to move lower, it meets an immediate buying response. Most importantly, the key lows remain intact, suggesting that the internal bullish structure is still being successfully defended. The market is consolidating above this institutional support, and our task now is to monitor whether this zone will trigger a definitive expansion or if order accumulation continues. We are now switching from the 5-minute timeframe to the 3-minute chart to observe the price action over our zone of interest in greater detail. It is evident how the pair is reacting positively to the 5-minute order block we identified earlier. Price has not only stopped falling but is using this institutional block as a launching pad. Notice the rejection in the lower wicks of the candles. This confirms significant buy order absorption at this level. Despite the typical volatility of this first hour in New York, the structure remains solid, and key lows remain protected. We are seeing a very important technical validation that strengthens our hypothesis of a possible upward expansive move from this support base. We are returning to the 1-minute timeframe because the entry patterns have finally aligned with precision. Notice how a new fair value gap followed by a 1-minute order block has just been created, right above our major support zone. The most decisive factor for making this move is that price is respecting the lower liquidity zones much more strongly than the upper ones. Every pullback attempt is immediately halted by buy orders. At this point, we proceed to trigger the trade. The structure indicates a clear intent from the market to expand, using these new 1-minute supports as drivers to attack the previous highs. We set our risk in a controlled manner, trusting that the lower liquidity will act as a solid wall for our stop loss. Notice the immediate response following our entry. On the 1-minute timeframe, price is confirming the validity of our zone by pushing strongly from the short-term order block and fair value gap. The trade is now active, and the price action is exactly what we were looking for, an aggressive displacement leaving the protected lows behind. At this point, our management focuses on monitoring how the pair approaches our first take-profit target. The continued respect for the 1-minute structure gives us the confidence to hold the position as institutional order flow drives the price toward the upper liquidity. In this screenshot, you can visualize the risk management for our entry, where we have set a 1-to-2 risk-to-reward ratio. It is vital to keep in mind that the market is dynamic and will not always allow us to get this exact proportion. There will be times when conditions provide a higher ratio and others when we must settle for a lower one based on price action. What matters here is consistency and capital protection. Notice how the stop loss is protected below the 1-minute order block while we aim for the target in the upper liquidity zone. This structure allows us to trade with a clear statistical edge, accepting that every trade is unique in its development. The trade continues to develop in our favor. As you can see in this transition, price has reacted strongly, validating both the 1-minute breaker block and the IFVG. We are seeing a clean expansion toward our upper targets, while the higher-low structure remains intact. At this point in the session, buying pressure is evident, and institutional order flow is pushing the pair directly toward our take-profit zone. We maintain active management, watching as price moves with the fluidity we expected following the New York Open. As the blue arrow indicates, our final target is set a bit higher, but we must remain cautious. Price is approaching the 1.1800 area, a round number that psychologically acts as a natural resistance where many institutions often take profits. Notice how, upon touching that level, the pair experiences an immediate pullback. It is a reminder that trading is not a straight line, round levels create friction, and it is perfectly normal to see these contractions. Our management now consists of observing whether this pullback is simply a breather before continuing the move up or if the market has lost the strength needed to reach our final take profit. Patience at these critical levels is what separates a professional trader from an amateur. Following the pullback at the round number, the chart shows renewed intent. I have marked with blue arrows the immediate liquidity zones that price is about to absorb. These local highs act as magnets, as buy stops from those who entered short prematurely are clustered above them. The 1-minute structure remains bullish, and the fact that price is attacking these liquidity zones confirms that the institutional order flow has a clear target. We are monitoring the speed of price delivery in these areas to ensure that buying pressure is sufficient to reach our final take profit level. Notice the precision of the move now. Price has just completely consumed the upper liquidity we had identified. As you can see in the 1-minute structure, the pair has forcefully broken through local highs, invalidating sellers' orders and using that momentum to catapult toward our take profit zone. price reaches the 1.1804 level, completing the institutional liquidity sweep surgically. This is the result of following a clear roadmap and trusting the supply and demand zones defined from the start of the session. The market has delivered the expansive move we projected, validating our technical reading impeccably. Price delivery continues to be extremely efficient. After sweeping the previous highs, notice how the pair shows no signs of an immediate reversal, but instead continues to consume the remaining liquidity at higher levels. This is confirmation that the institutional order flow is fully aligned with our move. The 1-minute structure remains flawless, allowing the trade to flow naturally toward the definitive exit zone we had projected. As the blue arrow points out, the price has encountered significant resistance right as it interacts with the round number. It is fundamental to understand that these psychological levels act as high supply zones, where the market often pauses before being able to consume the remaining liquidity. This pullback does not invalidate our thesis, it simply shows us that the pair needs to build new momentum to break through this technical barrier. Notice how the price reacts to this resistance, which requires us to maintain strict and professional management while we wait for the definitive resolution of the move at the top of the range. The scenario is completed with absolute precision. As you can see, price finally consumes the upper liquidity zones after successfully validating the previous support levels. The blue arrows tell the full story. The lower one marks the round number where price found the necessary support to drive upward, and the upper one points to our successfully reached target. This move confirms that, once the psychological barrier is broken, the market accelerates toward institutional exit points. The trade has reached its final destination, proving that patience and respect for technical structure are key to navigating New York's volatility. The trade concludes with resounding success, hitting our target after a precise reading of liquidity and institutional levels. This trade is the perfect example of how patience and multi-timeframe analysis provide a real edge in the market. If you found this content helpful and want to continue learning how to interpret price action this way, I invite you to subscribe to the channel, hit the like button, and share this video with fellow traders. Your support is vital to keep bringing these analyses to you. Also, if you have any questions about today's concepts, feel free to leave them in the comments. I always reply to help you on your journey toward profitability. See you in the next analysis.